Hello, everybody. My name is Mathew Owens, and welcome to Masters of Real Estate. Today, I'm going to talk all about promissory notes, but more specifically, I'm going to talk about how to protect yourself when you're dealing with the borrower and the due diligence on the borrower, as well as the due diligence on the actual asset and the property. I'm also going to talk about the differences in the paperwork and what things you should know to protect yourself on the paperwork. And then finally, I'm going to cover how to solidify a streamlined cash flow stream through promissory note investing and how to actually retire off of investing in promissory notes. So there's a lot of differences between real estate and investing in promissory notes. Yes, the real estate is your collateral when you are investing in promissory notes. At the same time, there's some big differences in the investment side of things. For example, real estate goes up and down when it comes to the volatility of that cash flow, right? You have tenants move out, you might have repairs, you might have a value add strategy that you are increasing the cash flow over a period of time through renovation or through expense efficiencies and things like that, right? And so there's some little bit more volatility. While on the other side, when you're dealing with promissory notes, you typically have a much more even cash flow stream to protect yourself. In addition to that, you can get some big built-in equity when you are investing in promissory notes. Most of the investments that I invest in are anywhere between 65% to 75% of the after repaired market value or the market value of that asset specifically. So it gives me some great equity protection so that if something is to happen, I'm able to take that property back and be able to get a great chunk of cash flow or cash for the equity in that deal. If I was going to resell that property or rent it to a tenant and get additional cash flow that way, there are great exit strategies and risk mitigation techniques when you are investing in promissory notes specifically. So OCG, we have a Be the Bank program where we actually do everything for our investors. We do the servicing, the underwriting, the processing, the collection efforts, the payoffs, all the different stuff that happens, we help our investors do and act as that service provider to help our investors invest in streamlined cash flow strategies. We have investors that make $10,000 to $50,000 a month and are literally traveling the world right now via retirement because of the cash flow strategies we're able to deploy and some of the promissory notes that we're able to provide to our investors. But it's not all, rosy, everything's amazing all the time. When it comes to investing in any asset, you have to make sure you do your homework. And so let's talk a little bit about how to do that, how to protect yourself when you're investing in promissory note type investments. So the very first thing that you should be doing is, before you even vet the deal, is vetting the borrower. Are they the type of person that is going to repay you? Can you do criminal and financial background checks on them, credit checks on them? Do they have the proper reserves set up to be able to successfully complete that deal? And that means not just all the interest payments through the close of that loan, but renovation overages, other headaches that could come up, a lot of the holding costs involved. Do they have extra just in case things happen, right? And what happens if the value drops in value during their renovation or they're wrong on the market value? Appraisers are not always right on their deals. Shocker. So it's really important to be able to say, what happens if the value drops by 5 or 10%? Are they break even on their flip? Are they going to go through and default on that loan? Do they have enough capital to be able to pay you off on your promissory note and abide by that contract, right? In addition to that, do they have experience doing the flip? There's a lot of risks out there outside of just, is the value there? Do they have enough reserves, right? So There's, for example, property contractor risk. So the renovation could go over budget. That's a very big commonality, especially with inflation now out there. So it's really important to dial in the experience level of the borrower. Do they have experience not just in real estate, but in the market they're doing business in? Do they have experience with the contractors and the team and their sales agents over here when they're going to go sell that property? Who is their team, and do they have experience with that particular team? And do they have backups for those team members in place? Because I can tell you from firsthand experience, after flipping over 1,000 houses now, contractors are great for a period of time, and then things happen, right? They might get overwhelmed with too much business because they're going out trying to hustle, make sure that they have that next payday so they can pay their crews, pay their team, and keep them consistently busy, or they lose them, right? And that's a very valuable asset to that contractor. So making sure that you have secondary team members when you're doing a flip as a backup plan if your contractor falls out or gets too busy or runs out of money. How good is that contractor at being able to balance their own budget with their own guys? And are you taking that hit yourself if you're the flipper involved and taking that liability on for your contractor? Because at the end of the day, it falls on you if they run out of money on a project, right? So there's a lot of things that go into that upfront due diligence when it comes down to the team, the operator involved, and their performance and their experience. So that's number one, making sure that the operator is going to be able to succeed and do that flip. What does their character look like? Do they respect your capital enough to make sure you get paid back, and respect the relationship enough to want to make sure that you are taken care of as the lender in that relationship, right? Okay. Number two is to be able to actually vet the deal in itself. So you have the market value of that asset. You're going to go get an appraisal every time, but you're also going to look at the comparables yourself and see, do you agree with that appraiser? Are there comparables that they have not used, that they use comps that were outside of that particular area? You want to be able to make sure that you understand the streets that you are investing in, and you're not crossing certain dividing lines that maybe that appraiser came from a national appraiser company and doesn't know that specific area. I can tell you firsthand, I've bought properties in the past where there was one house on one side of the street. There's a busy street. All of them are going for $450,000. On the other side of the street, same street, literally across the street, going for 150,000, because that particular street on that side is the dividing line with school districts or with gentrification in the area. There's a million reasons why that may change it. So I've been bitten. And so that's why it's important to understand these key concepts about your appraisal and making sure you agree with that appraiser, and you're actually going out understanding the neighborhoods enough to be able to protect yourself. Okay. Secondarily, the next biggest ticket item I keep harping on is the renovation in itself, right? Did the operator provide you with a detailed renovation bid, right? And how detailed is it? Does it break down materials, labor, and every major system involved? The HVAC, the roof, the plumbing, the electrical, the foundation, all, the tuck pointing on the outside. All these things are very big ticket items that, if missed, could blow your budget out of the water and make the entire deal fail. So how put together are those renovation bids when they bring them to you? And did their contractor put those bids together, or did they put it together? Many times the contractor will come in and give them one lump sum number and not know if they can do that job for that price in reality, because they're really not doing the math. They're just saying, yeah, spitballing it. This is what I think I can get it done for. So really important to dial in that renovation. You can actually do feasibility studies. We do this for large renovations that it's hard to tell how much that renovation is going to cost. After 1,000 flips, we can really dial in how much we think that's going to cost. But the costs have gone up because of labor inflation, materials inflation. There's all different types of issues going along in the space. So don't take the wholesalers word for it when they're actually dealing with the selling you the asset, right? You have to be dialing in your actual rehab yourself. And if you're the lender, you want to make sure that operator really knows the renovation and has everything covered. There's what's called a feasibility study. You can send somebody out to the asset, you can do inspections on that asset to make sure everything at the property that looks like it needs work is really handled in depth. Okay, so that is extremely important to understand. What is your neighborhood analysis? What is the market value? What is the renovation? What is the profitability on that project as a whole? Is there enough margin for your flipper that you're lending money to, or your homeowner when you're lending capital there? There's legalities involved, of course, when you're lending to homeowners, and there's also legalities depending on the state when you're dealing with lending to flippers on a business purpose loan versus homeowner loan over here. Dodd-Frank and the SAFE Act govern the homeowner loans over here, so you need to get the proper licensing to do those types of transactions. There are some exemptions in certain states for licensing, but you got to research each individual state. Over here on the commercial side, it's a lot easier. Many states don't require licensing to do that, but some states like California do require licensing to originate a loan, negotiate the loan, and actually give the loan out, even if it's for commercial purposes. So understanding some of those nuances in the states that you're doing business in, and is there enough margin, like I was saying, in the actual flip to be able to make sure that operator is making enough profit, even if the value goes down, even if the renovation goes up, to want to stick around and get that deal done. I always personally go get personal guarantees when I'm lending the money, so that way they're on the hook if I have to take over the property and have any potential losses or anything like that can occur, right? And so, but that's why I also lend at 65 to usually 75% max of the market value of that asset, so that I have that equity protection. Because what happens if I have to take over? I have some legal costs involved that I have to pay for. I'm losing interest. Maybe I'm paying my other investors out if I'm bringing investors in. And so I have interest costs there. I might have some cleanup costs and some renovations if they ran out of money because the renovation went over and now I have to go fix that asset. So that's why I lend at that lower price. And you should be happy in any promissory note if they abide by the contract and pay that contract. You should also be happy if you have to take over that property and take it back and get a good chunk of equity for doing that. So these are all key things to consider when you're vetting the deal, the operator, and the overall loan in itself. Okay. Next big piece of information that you should be understanding to protect yourself is the paperwork involved, right? So normally in a promissory note situation, you have the promissory note. That's the contract that gives you the terms. This is your interest rate, your payment due dates, your maturity dates, the clauses and the late fees. That's the contract that needs to be abided by. You also have usually a deed of trust or a mortgage, depending on the state, that secures your money by the property in itself so that you are protected, okay? And you have to make sure that you are in first position on that particular deal, which you do that through the proper title insurance and title searches and things like that. And you always want to get the additional endorsements so that if there's any unrecorded contractor liens, you are also covered with regard to those additional contractor liens that may not necessarily be recorded at the time. Okay, so those things are extremely important to understand. I always get lender's title coverage. There's also homeowner's title coverage, but I get coverage for my entire loan amount. In addition to that, you want to make sure you have general liability insurance on the property, and you as the lender are the loss payee. So if something is to happen on that asset, where there's a fire or something like that, you as the lender get paid back first, and then can determine, is that enough money to repair the property? Can I go lend that money back to them, back to the borrower, to cover that piece of it, so that way they are taken care of on that fire or that peril that occurs, right? So in addition to the title insurance and general liability insurance, you want to make sure you have the promissory note. You want to make sure you have a deed of trust that secures that money by the property. Now, when you're buying notes, you also want to make sure that you get an assignment of that deed of trust. So when you're selling a note to somebody else, or you're buying a note from somebody else, you get what's called an assignment of deed of trust. So that deed of trust is recorded at the recorder's office and securing your money. And now you are assigning that note to someone else to sell that note off. Or if you're buying the note, you are getting the assignment, and that assignment gets recorded to record your interest in that property, not the person that sold you the note's interest in that property. Okay. So typically that's the case. You're going to go and get an assignment of deed of trust. You also get what's called an allonge, which is basically signing over the ownership of that promissory note. Now, you can sign over a percentage of that promissory note as well in the document. You can also assign over a percentage in the in the assignment of deed of trust too. You don't have to assign the entire deed of trust. You can assign a percentage of it so that that person is recorded at the property based on their percentage ownership in that asset. I always also get a personal guarantee from the borrower so that I have that documentation in place. You want to look at a full property package that has the appraisal in there. It has the rehab bid. It has all the pictures. It has all the borrower's information, their application, all their personal guarantee documents. The entire document package should be put together for you to review to make sure and determine that's the right investment for you. Okay. And you want to be looking at that asset in particular to say, do I want to own that asset? Am I happy with that asset? Am I okay in that kind of situation? Right. You can also invest in pools of promissory notes run by other operators in a fund scenario. There's so many ways of buying promissory notes. It's really interesting. And you want to have a servicer set up if you're not going to be the servicer yourself, so that they can do the construction draws for you. They can manage that investment and make sure the payments are coming in correctly and things like that. Okay. And not all servicers are created equally. A lot of outside servicers don't really go that far in their collection efforts. So you may have to come in as a backstop to do additional collection efforts if there's issues there, or if something's wrong with the renovation and you're not doing draws. You want to make sure that that occurs correctly at the servicer's level. So in a nutshell, the paperwork, you're getting the promissory note, the deed of trust, or the assignment of that deed of trust if you're selling it to someone else, with an allonge to protect yourself, along with the entire property package to make sure that you are covered. And usually it's really great when you're investing in promissory notes because they can be much more liquid than real estate as a whole as well, because the way you sell real estate, you have to go through an escrow. There's usually commissions involved and closing costs and all different types of stuff that you have to cover. And so it's relatively illiquid when you're selling real estate. It takes time, right? You might have to wait for them to get financing, or if they can't take it down in cash, you might have to have inspections. There's all different types of stuff that has to go into that. When you're selling a promissory note, you're actually going through and selling the paper. So it's much more easy to sell paper than it is to sell the actual property. So the way you do that is you have the assignment of deed of trust, you have the allonge that goes into that, you get your proper paperwork involved in that sale, and you also have a loan purchase and sale agreement, not dissimilar to a purchase and sale agreement for a property involved. Many times there's a purchase and sale and servicing agreement because the seller might retain servicing or help out with servicing, just like we do in our OCGB, the bank program, where we have a lot of private investors investing directly into promissory notes with us, and we build portfolios of assets for our investors. I would also highly recommend going out and diversifying into multiple notes, which is why I like the fund structure, because you can diversify into multiple notes instead of just one note. Because if that one note goes into default, you are not getting your payments for that entire note, versus a pool type situation. There might have to be a much greater default rate along the pool for you to not get paid or not get a certain return on your capital in the pooled situation. So These are some of the main keys to be careful of when you are selling notes and the paperwork involved and the due diligence for the borrower and the operator. Now, when you are developing a solidified cash flow stream through promissory notes, it's important to understand some of the key focal points and key things that will stop that cash flow coming in, right? One is defaults. Making sure that you have a very low default rate through the proper homework upfront is absolutely key to your long-term success in promissory notes. Secondarily, I think investing in multiple promissory notes is very key to pool that investment into multiple so that you have some, diversification there with regard to your notes. Third is actually going out and finding other operators and originators that are originating notes over and over and over again that can provide consistent supply of those notes available so that way you don't ever run out. Because many times, for example, when we do construction loans, we actually go through and do 12-month construction loans. Sometimes they pay off in 6 months, sometimes 3 months, sometimes 12, sometimes there's an extension to a year and a half or something like that. But they can be very short term, and so you have to have the ability to redeploy that capital. And the best way to do that, unless you are originating yourself and finding these notes all over the place and doing tons of marketing yourself, is to find other originators that are in the business of originating promissory notes to either fix and flip investors or buy and hold investors that are renovating and refinancing to hold that asset, or being able to take your own real estate and turn it into paper via seller finance strategies and creating your own paper involved in that asset. So making sure that you have a consistent ongoing supply can be key. Now, I personally like to invest in properties as well as promissory notes because properties can give you tax benefits. You can have complete control of that asset long term and get long-term cash flow on it. It's an inflation hedge, especially if you have underlying debt that gets decimated with that inflation. But there's some more volatility to that cash flow. Like I mentioned earlier, it can go up and down. On the other side, the promissory note structure doesn't give you the inflation hedge or the tax benefits and things like that, but it can give you a little bit higher cash flow stream along with a consistent cash flow stream in that monthly payment. But it also can pay off, consistently, and you have to redeploy the capital consistently. Now, you can invest in long-term promissory notes as well. Just make sure you are getting a high enough return to beat inflation in that kind of scenario so that you're covered and can actually develop this cash flow stream. Like I said, I have multiple clients that have a lot of capital with us in promissory notes that are getting consistent cash flow streams where we are just able to keep redeploying their assets over new promissory notes over and over again so that they have this cash flow stream and they can go travel the world and retire. So I hope this helped give you some clarity as to some of the pros and cons and due diligence that you should be doing to develop a passive cash flow stream through promissory notes so that you can retire and be able to live the life you want, because really the most important thing is time freedom. So I hope this helped. Enjoy. If you guys want to learn more, you can check out my other videos on this, my other videos on my YouTube channel or my podcast. You can go to my website at MathewOwens.com with one T in Matthew. So MathewOwens.com. And I look forward to talking with you guys soon. Do you want to learn how to create financial freedom in your life through real estate and take your investing business to the next level? If so, you can follow us in one of the following ways. First, you can take one of our free webinars on how to analyze property, how to raise capital for real estate, and how to market and find deals. 3 of the key pillars to becoming a successful real estate investor. Number 2, you can join us on our mailing list where you'll get tips and tricks on real estate investing directly to your inbox. And number 3, you can take our 6-month real estate course that teaches you every aspect of real estate investing you can think of, and more importantly, create financial freedom in your life through real estate investing strategies that I teach. If you want a master's in real estate in 6 months, this course is for you. We're going to go over how to raise money, promissory notes, syndications, fixing and flipping, buy and hold investing, tax and legal structures, self-directed retirement accounts, financial education, how to run a business, how to market and find your deals, and most importantly, how to create that financial freedom in your life so that you can stop trading your time for money and create passive real estate cash flow that you can live off of. If you're interested, go ahead and click on one of the links below, and I look forward to seeing you guys on the other side.